Good morning. This is Yahoo Finance Live. I'm Julie Hyman with Jared Blickery and Brooke DePalma. And we are awaiting consumer price index data that is coming out right now here. Let me bring you the numbers. 0.4% is the CPI month over month. That is bang in line with estimates. Ex-food and energy, though, a little bit hotter than estimated, rising 0.5% versus the 0.4% that is estimated. Let me tell you about the year-over-year numbers as well. 6% year-over-year headline, 5.5% core, that is excluding food and energy. So both of those right in line with estimates. So we actually saw a touch of acceleration in the CPI number on a month-over-month basis. This is not what the Federal Reserve wants to see, so let's call it a little bit hot here, of course, following on the heat that we got from these numbers in January. All of these numbers I've been discussing right now are February numbers here. When we talk about these numbers, obviously there are implications on a number of bases. It means that people are paying more for stuff, right? Paying more than they did the month before at a time when inflation has already been taking a big pinch and a big bite out of people's wallets and pocketbooks and family budgets. The other big implication, of course, is for the Federal Reserve and whether they're going to be raising interest rates. And Jared,
yes,
that question is a lot murkier now than it was last week at this time because of the implosion of Silicon Valley Bank. And so now the Fed has to consider that and the soundness of the financial system in addition to its dual mandate of price stability and full employment.
Yes, and I can't underscore the importance of this report enough, because had this come in weak, had this come in more favorable, showing less inflation, this would have given the Fed a free pass to skip over the next meeting, saying we're not going to hike rates at all, or we're going to raise rates by 25 basis points. Here, they almost have to raise by 25 basis points. I've seen speculation that they may dabble with some reining in of quantitative tightening, because remember, they're going through a process where they're winding down their balance sheet. That's draining liquidity. That's creating issues in the bond sector for banks. Part of that is why SVB failed. And just taking a look at the Wi-Fi Interactive here, we got some initial reaction in stocks here. So this is S&P 500 futures. Hard to see, but this little candle here, this is a 1-minute candle, dipped all the way down to lows around 38.55. Then it's back up. So pretty much net, not really going far to the upside. NASDAQ futures showing a very similar story. Got this long tail here, tested the overnight lows, but back up. Dow futures, I'm going to think, yeah, pretty similar situation. And let me show you what's happened over the last 5 days here. Here's the Dow. Let me just go to the S&P 500 futures. And you can see really volatile price action coming into the late last week, but things have settled down a little bit after, I guess, markets have had a little bit of a chance to digest this failure. All in all, we were talking about the Federal Reserve. I think this creates a situation that the next meeting next week is going to be a referendum on financial stability in the U.S. Because if the Fed has shifted into the macro-prudential mode, where they're more worried about systemic risk than they are about the immediate effects of price inflation, that would be a big change.
Yes, it would. It would be a very big change. And we should mention, as I mentioned, there's sort of two aspects of the CPI report. There's what the Fed aspect, and there's like what people are actually paying. So the Fed doesn't really consider food and energy, but we all do. And that's why Brooke is here. She's taking a look at the food equation. So, Brooke, Absolutely. What are you seeing in those numbers?
Well, I first want to start with some good news here. Eggs, hot topic for many consumers out there. Month over month, they're actually seeing a decrease of 6.7%. That is the largest decrease that we've seen in quite some time. Of course, last month, eggs were up 70% year over year, up 8.5% month over month. So this year over year, eggs still up 55.4%, taking a larger, broader picture. Food up 0.4%, but groceries up just 0.3% month over month. Year over year, though, still seeing some inflation there, up 10.2%. Now, if we take a look at food away from home, that's actually bumping up a bit month over month, up 0.6%. Year over year, food away from home, so dining at restaurants, bars, up 8.4%. Now, once again, eggs seeing a decrease there. Meat, poultry, fish, and eggs brought down lower, down 0.1%. By that egg number, that's one of the biggest food spending categories. And so maybe some relief here coming for consumers.
Maybe a little bit of relief coming to consumers. But if the Fed is still raising,
right,
then that's, has other repercussions, of course, across financial markets on the flip side. For everything you need to know about the Silicon Valley Bank collapse, check out our morning brief newsletter over at yahoofinance.com. It's written by Brian Sozzi. And Saz, you highlight in the newsletter some things Wall Street is saying about the collapse. They're saying a lot.
There's just so much going on, Julie.
There's so much going on. Can I just say for a second, too? We're all doing this over the weekend.
Yes.
The time changed. Which is like the worst possible timing.
My
for
bagel
the time to
came
change.
out burnt on Sunday morning, Julie. It just stinks. But in terms of the morning brief newsletter, look, I'm really locked in on what Wall Street is saying right now and what Wall Street is not saying. A lot of folks, I look at what JP Morgan's main credit analyst said yesterday afternoon. Caprahan saying this is not a structural or systemic issue. So, as someone who covered the financial crisis of 2008 and 2009, I still don't get the vibe that this is that type of situation by any stretch of the imagination. That was just a scary time. Not that this is not scary, it just feels and looks very different. And then you have out here this morning, you have a Citigroup coming out here trying to pick the bottom on Charles Schwab, upgrading them. Schwab came out this morning saying things have started off pretty well in terms of trading activity in March. We are well capitalized. Things are looking good there as well. And then you have First Republic. You have JP Morgan coming out here actually recommending to buy this stock that is absolutely crashing here in the pre-market, down 63%.
And then there is the bigger question of rising interest rates, which, as we talked about earlier, was a big contributor to this whole mess. Will they keep rising? Goldman Sachs this morning, Jan Hatzius and the team over there saying, no, the Fed is not going to raise at the meeting next week. We'll raise after that. Morgan Stanley is saying, yes, they will probably raise, and they even see a path still to 50 basis points. Citi also saying that the Federal Reserve is still likely to raise rates. So obviously some big implications.
Lots going on.
The collapse of two major banks, all the talk over the weekend, likely had lots of Americans, maybe you worried about the potential impact to your own finances. Today, our Alexis Wainwright speaking with local experts to explain what this could mean for you.
This has definitely taken the country by storm, hearing that a bank fails.
But after seeing the second largest bank failure in U.S. history happening with the closure of Silicon Valley Bank and Newbay Signature Bank, more fear is looming.
And so what's different now from 2007 is that largely the banks are much healthier, much more capitalized. They're flush with liquidity right now.
UT at Dallas Associate Economics Professor Victor Valcarcel says thankfully things will be in better shape since federal regulators jumped in to help. Now insured depositors are expected to receive at least $250,000 from the FDIC. Meanwhile, others will have to file a claim that could be reimbursed.
Now, these deposits then, since they are insured and the insurance does not come from the government or from the taxpayer, in essence, what that serves to do is kind of put a hand on that dipping domino, so it doesn't kind of create a contagion effect to the rest of the banks.
This could have a domino effect on tech companies and investors who are still waiting to see if they'll receive all their money back. Meanwhile, Open Air advisor Stuart Field says this collapse serves as a reminder for everyone.
So there is the advantage of diversifying some of your savings and checkings accounts, not to put them all at one bank.
Fields offers some advice.
Is ask good questions. Do your research, making sure that that you have up to $250,000 per account.
As far as what's next,
prior to this weekend, the markets largely expected an interest rate hike, and that's largely off now.
In Dallas, Alexis Wainwright, CBS News, Texas.
Jared Blickery is at the Wi-Fi Interactive, and we have just seen incredible movements in the market.
We're seeing some more today. And by the way, excellent explanation there, Julie. And